ETFs, short for exchange traded funds, offer the ability for nearly anyone to easily and efficiently invest into the stock market and build wealth over time, which is exactly why they have been growing at an incredible rate over recent years. And if we look at the cumulative net flows into ETFs, they have been on the rise when compared to mutual funds that have actually been on the decline. Now, if you don't know what ETFs are, they are pretty much a simple way for you to invest into hundreds to thousands of different investments, all within one purchase that makes diversifying a portfolio much easier to achieve, leading to reduced risk when compared to buying individual stocks. Many are also very cheap to own, and with the right ones, they've historically done very well for investors that have held onto them. So knowing that, I'm about to show you exactly how to build an ultimate ETF portfolio, starting with ones that serve as a great foundation to a portfolio, to ones that are then more on the strategic tilted side, to then diversifiers, and even optional dividend ETFs if you are interested in dividends. But before we get started, my name is Sully, and all I ask is if you do find value in this video, that you consider hitting the like and subscribe button for future content like this. With that said, let's first go over what I refer to as the foundation to an investment portfolio, where for many, I would view this in the range of 50 to 70%. Now, because ETFs can be so broad, there are only two types that I personally believe are best suited as the foundation for many portfolios, but of course, everyone's opinions are different. This is not financial advice, and you have to make your own financial decisions. But knowing that, the first one to mention here is what the legendary investor Warren Buffett actually recommends, and that is the S&P 500, where he specifically suggests Vanguard's, that is the Vanguard S&P 500 ETF with the ticker of VOO, which is currently the largest ETF in the world based on its assets under management being roughly $839 billion. Now, if you don't know what the S&P 500 is, Vanguard simply explains how it represents 500 of the largest US-based companies, where it is considered a gauge of overall US stock returns. And so the key things to know about this fund include the fact that it officially launched in the year of 2010. It has an expense ratio of 0.03%, which is the total cost of owning this fund per year. And as you can see in our design created from InvestLane, that means for every $10,000 that you invest, you would be paying $3 per year in fees. It's literally nothing. Aside from that, the fund has 505 holdings, and understand that the S&P 500 is considered a market cap weighted index, which means the largest companies that are in the fund carry the most weight towards the performance. And so if we look at the top 10 holdings, you probably heard of most, if not all of them, like Nvidia, Apple, or Microsoft, where they each contain about 6 to 7% of the weight toward the fund. So because of that, if we were to add up the top 10 holdings that are inside of VOO, they make up roughly 40% of the entire weight that goes toward the fund. And largely because of those top companies, the largest sector in VOO is information technology at roughly 35% of the weight toward the fund. But from there, also know that VOO over the trailing 12 months has paid a 1.12% dividend yield, where it's averaged 14.78% of an annual return over the past 10 years. And because it's the S&P 500, it has 100% of an overlap with the S&P 500, which not to mention, but that is a metric that I personally like looking at because I already have so much exposure to large cap stocks. I like to know that for other investments that I consider. Now, also know that there are many other S&P 500 ETFs that you could choose from that are very credible options, such as IVV, SPYM, or for those that are actively trading, you may benefit more from SPY due to its high trading volume. But aside from adding an S&P 500 ETF, the next one I personally like adding to the foundation of a portfolio is also a large cap growth fund like SCHG, VUG, or QQQ. For long-term investors, simply buying and holding, that could be QQQM. And so because my current favorite right now is SCHG, if we look further into this fund, you'll see that it seeks to track the total return of the Dow Jones US Large Cap Growth Total Stock Market Index, where the fund provides simple access to large cap US equities that exhibit growth style characteristics based on a number of factors. Now, SCHG currently has $53 billion in assets under its management, which by the way, QQQ and VUG are ranked as some of the top ETFs in the world at number 5 and 6. But to add on SCHG, the fund was created in 2009, has an expense ratio of 0.04%. There's a total of 198 holdings in the fund, where the top 10 holdings here are very similar to the S&P 500, where Nvidia, Apple, and Microsoft are also at the top with even more weight to them. And that is exactly how the top 10 companies in SCHG make up roughly 58% of the entire fund when compared to 40% that are in the S&P 500's top 10. And then if we look at at the dividends for SCHG over the trailing 12 months, it has produced a 0.36% yield. And I also have to add that this fund has computed from the year of 2024 to have nearly 100% of the dividends triggered as qualified dividends, which makes this a very tax efficient investment to hold on to, especially over time. And yet alone, over the past 10 years, the fund has averaged 17.94% per year, and it currently has a 55% overlap by weight with the S&P 500. So as you can see, I personally view the foundation to an investment portfolio to be broad exposure to large cap US stocks, but to continue building on this ultimate ETF portfolio, the next category here to mention would be towards strategic tilts that I'd recommend a common range of 20 to 40%. Now I know the two ETFs I just mentioned were solely large cap stocks, but before I move on to other segments of the market, the next ETF cannot be overlooked, and that is the Invesco S&P 500 Momentum ETF with a ticker of SPMO, where this fund tracks the S&P 500 Momentum Index, which means it tracks the performance of stocks in the S&P 500 that have a high momentum score, where the holdings are weighted by their market capitalization, their size, and their momentum score. And so looking at the data, you can see that this fund has $13 billion in assets under its management. It launched in the year of 2015, has an expense ratio of 0.13%. There's a total of 100 holdings, and the top 10 alone make up 52% of the entire fund. Not to mention, but its dividend yield over the trailing 12 months was 0.73%, and interestingly enough, the fund has averaged a 17.85% annual return over the past 10 years. I say that's interesting because that is more than 3% higher of an average per year than VOO, and SPMO has only a 30% overlap by weight with the S&P 500. And so because this fund has recently caught my attention lately, I also want to point out a few more facts when compared to the S&P 500 ETF that is VOO, because if we look over the past 10 years, SPMO would have turned $100,000 into $523,000, where VOO would have been $100,000 into $397,000. So not just has it outperformed by more than 3% per year on average, the standard deviation is also not that much higher. SPMO's best year was up close to 46%, where VOO's was up 31%. And then even more interesting is that the worst year for SPMO was only down 10%, where VOO's was down 18%, and the maximum drawdown for SPMO was 21%, when compared to the S&P 500 that was nearly 24%. Which, not to mention, but the Sharpe ratio, which measures an investment's return per unit of risk, is also higher for SPMO by quite a bit compared to the S&P 500. All in all, this is a very interesting ETF to look into, and is also why I've added the next ETF on my list to consider, that is the Invesco S&P Midcap Momentum ETF with the ticker of XMMO. Now this fund is also from Invesco and is based on the S&P Midcap 400 Momentum Index, where it is composed specifically of the top 80 securities that are in the S&P Midcap 400 Momentum Index having the highest momentum scores. Now, XMMO currently has about $5 billion in assets under its management. It launched in the year of 2005, and it has a higher expense than the previous ones I just mentioned. That is a 0.35% expense ratio. The fund currently has 79 total holdings, where the top 10 alone make up 33.2% of the entire fund. The fund over the trailing 12 months has paid a 0.77% dividend yield, and if we look over the past 10 years, it's averaged 17.29% per year, and there's a 0% overlap with the S&P 500. Now, if we look at this comparison again through Portfolio Visualizer, you can even see that the higher average returns from XMMO, the worst year, and max drawdown were still slightly better, and if you want, feel free to pause and compare other data that's on the screen. But moving on from mid-cap exposure, the next ETF that I want to mention here is tilted towards small cap value stocks, and I know it doesn't sound very strong or even growth oriented, but after all the research that I've done throughout the years, this has come out to be my top pick for small cap exposure, and here's why. First, understand that AVUV invests in a broad set of US small cap companies and is designed to increase expected returns by focusing on firms trading at what we believe are low valuations with higher profitability ratios. And so the fund currently has $20 billion in assets under its management. It launched in the year 2019, has an expense ratio of 0.25% with a total of 776 holdings. Based on that, if we look at the top 10 holdings, they make up 8.36% of the fund, showing that this is very diversified among these small cap individual companies. The fund has not been around for 10 years, so if we look at the past 5-year average, that has returned 14.31% per year, and do know that there's 0% of an overlap here with the S&P 500. Now, for those curious, all of the data points that I'm mentioning in this video are coming from consistent sources for each point that I mentioned, where a few that I used are Seeking Alpha, the Fund Overlap tool from the ETF Research Center, Portfolio Visualizer, and each fund's official websites. So if you want to see other top financial tools and resources, I'll have a direct link in the description below to many of the top options you could use. But from there, the next on my list is the Vanguard Information Technology ETF with the ticker of VGT, where this fund is considered a sector ETF since it solely tracks the information technology sector. Now, this fund currently has $114 billion in assets under its management. It launched in the year of 2004, has an expense ratio of 0.09%, a total of 322 holdings, where the top 10 make up roughly 59% of the entire fund. It's also produced a low dividend yield of 0.41% over the trailing 12 months, and of all the ones I mentioned so far in this video, it's averaged the highest annual returns, being roughly 22.5% per year over the past 10 years, and do know that it also has a 34% overlap with the S&P 500. After that, I also have the Van Eck Semiconductor ETF with the ticker of SMH, and this fund is also a sector ETF, but now it tracks the semiconductor stocks, where there is $38 billion in assets under its management. It launched in the year of 2011, has an expense ratio of 0.35%, a total of only 26 holdings, where the top 10 make up roughly 73% of the entire fund, which is why this fund is known to be more volatile and may contain more risk, so you definitely want to be aware of that prior to investing into it. But do know that the extra risk when it comes to this fund specifically has actually been what allowed it to achieve even higher returns, where over the past 10 years, it has averaged about 30.3% per year, where it also has a 14% overlap by weight with the S&P 500. All right, so that makes up the ETFs that I consider as strategic tilts. Let's now go over a few more options that I consider more so as diversifiers, where I'd have the next three in the common range of 5 to 15%. Now, when I say diversifiers for this, I'm more so referring to investments that are outside of US stocks that I believe a small portion to each is worth considering, where the first one to mention here would be an ETF that tracks international exposure. And I've been mentioning this image for quite a while on my channel because the US has outperformed international for quite some time, but they do tend to have periods when international outperforms US stocks. Now understand that over the long term, US stocks have performed better, and is why I refer to them as the foundation and the majority of an investment portfolio. But even in this last year alone, international stocks have actually outperformed the US. In fact, the ETF that I'm about to mention that has the ticker of VEA, over the past year, it has grown about 32%, which is more than double the S&P 500 ETF VOO that computed about 15.5% of growth. But all in all, VEA is actually the 7th largest ETF in the world right now, where you can see it has $194 billion in assets under its management. And do know that this fund was created in 2007. It has a 0.03% expense ratio, a total of 3,864 holdings, where the top 10 make up 9.68% of the entire fund, where it's computed a 3.18% dividend yield over the trailing 12 months. And if we look at the average over the past 10 years, it has achieved 8.75% per year in growth, and there is a 0% overlap with the S&P 500. Now, also know that there are two other international ETFs that you may also want to compare with, and that would be VXUS if you want exposure to emerging markets, or IEFA, where a big difference is that this doesn't include exposure to Canada. But aside from that, another ETF that you may like to consider here is the Spider Gold Mini Shares Trust ETF with the ticker of GLDM, where it currently has $26 billion in assets under its management, where you may have heard of the more known ETF that is GLD, that is currently the 10th largest ETF in the world. But if you are one solely investing for the long term, they both track the price of gold, but GLDM is actually a cheaper version I'd recommend considering instead for long-term investors. But as far as GLDM, this fund launched in 2018. It has a 0.1% expense ratio, where GLD's is 0.4%. The fund tracks gold, pays a 0% dividend yield. GLD over the past 10 years has averaged 14.25% per year in growth, and this fund has 0% of an overlap by weight with the S&P 500. And then the last one to mention here is the Fidelity Wise Origin Bitcoin Fund. fund with the ticker of FBTC so that you could easily gain exposure to Bitcoin within an investment portfolio, where you could also consider an even more popular Bitcoin ETF, that is the iShares Bitcoin Trust ETF with the ticker of IBIT. But as far as Fidelity's FBTC, it currently has $18 billion in assets under its management. Launched in the year of 2024, it has a 0.25% expense ratio, it tracks Bitcoin, pays no dividends, and if we look at the history of Bitcoin over the past 10 years, it has been stated to average 49% per year, but that is very unlikely to repeat itself in the next decade now that Bitcoin has gone mainstream. For those curious on why I pick Fidelity over iShares, that is a personal choice because I am a huge Fidelity fan over BlackRock and also believe that over time, Fidelity is more likely to potentially cut the fees in the future, and that's at least my own opinion. Now, to prevent this video from being super long, if you want to customize your own potential portfolio like I did through Seeking Alpha, or you want to see how things would have done historically, don't forget to check out some of the top tools that I'll have linked in the description below for you. But to finish this off, the last category I'm including here is just the bonus add-on, that is optional dividend ETFs. Now, choosing dividend investments entirely depends on your situation. For me, I'm on the younger end looking to maximize my growth, so dividends don't really make much sense for me right now. And if you are one using a taxable account, that can also lead to what's called tax drag, which can drag down your investment's returns over time, where companies that pay low or no dividends, they use their extra profits to reinvest back into the business for further growth. But if you are one looking to add dividends to your portfolio, I'll keep it simple and just list off two of the top overall ones that I believe are in the market, where the first one is coming from Charles Schwab, that is the Schwab US Dividend Equity ETF with the ticker of SCHD. And so this fund currently has $72 billion in assets under its management. It was launched in the year of 2011, has a 0.06% expense ratio, 102 total holdings, where the top 10 make up roughly 40% of the entire fund. The dividend yield over the trailing 12 months was 3.78%. It's averaged 11.38% per year over the past 10 years, and it has a 7% overlap with the S&P 500. Then the other option I want to mention here is the iShares Core Dividend Growth ETF with the ticker of DGRW. That is $36 billion in assets under its management. It launched in the year of 2014, has a 0.0% expense ratio, 397 total holdings, where the top 10 make up roughly 26% of the entire fund. The dividend yield was 2.08% over the trailing 12 months. It has averaged 12.96% of an average return per year over the past 10 years, where the fund has more overlap with the S&P 500 being 43%, where SCHD's was only 7%. All in all, I have been investing, researching, and creating content on these topics for quite some time, and this breaks down my personal favorite ones I like, but of course, you have to make your own investment decisions. Which, don't forget, if you want to check out some of the top tools or even places to start a brokerage account or IRA, all of some of the top options you could choose from linked in the description below. At the end of the day, I want you to do what's best for your finances, but do know that depending on the ones you choose, I may earn a commission for it, which is greatly appreciated. And as always, don't forget to hit the like, subscribe, and notifications button for future content like this.